Hey, what's up, Moose? Mike from the Moose on the Loose. I hope you are doing well today. And today, as I told you earlier this week, I do have a special surprise for you. So I decided from time to time to invite Nelson from the Canadian Dividend Investing newsletter to come on the podcast. So today's going to be a special episode. 20 minutes instead of 10. So I hope that you have more time to listen to it. And we're also going to republish it on YouTube. So Nelson is an OG in the in the personal finance space. Has been blogging since like 2006 or 2007. So I'm gonna let you introduce yourself, Nelson. But we've known each other for a long time. Not talked too much over the past few years and then reconnect recently. So I think it's going to be a great addition for the Moose. So there you go, Nelson. Tell us a little bit more about yourself before we jump on the today's topic.
Well, first of all, Mike, thank you for having me on the show and for that great introduction. You talked me up more than what my wife talks me up, so I appreciate that. So, as you said, I am one of the OG original personal finance bloggers. Not quite as far back as what you gave me credit for. I started in 2010, I believe it was.
Oh.
And some of the old school people might remember it. It was Financial Uproar, which was basically just a bunch of dick jokes disguised as a way to make a serious point about finance. It worked, it didn't work. It was a lot of fun, though. So that was the main thing. And so I did that until about 2015, 2016. And then I just sort of took some time off of the blogging space. I was kind of dabbling a little bit here and there, but really came back in 2021 or so, where I was really just talking about stocks instead of personal finance. From there, Canadian Dividend Investing was born, and I've been doing that sort of full time now for like close to 3 years, is what that's been. So that's sort of my journey. I've kind of went from a deep value kind of investor to more of someone who loves dividends and mostly loves dividend growth. I have some stocks that don't grow their dividends, but for the most part, everything in my portfolio is chugging dividends higher over time. So that's kind of me in a nutshell.
And maybe one more thing that I find very interesting is you're not forced to work anymore already. So you're a young retiree.
That's right. In 2022, I threw off the shackles of work forever, or at least for a while, because I hit financial independence. I hit my dividend crossover point where the dividends covered my expenses. And at that point, it was kind of like, well, why work? So I stopped working a traditional job and started kind of doing my own things.
Yeah, and having just fun with that. So I love it. So all right, so today, because we are in the middle of this week where all Canadian banks are reporting their earnings, I thought of like we're going to go with our personal ranking. And the fun part is I have no clue what's the ranking for Nelson. So we're gonna go with position six to number one. We're gonna talk about each of them, what we like, what we don't like, and we're gonna find out if we agree or not. So that's gonna make it even more exciting for all listeners as well. So, all right. So let's start with number six. So we're gonna keep the best banks at the end. So most people know that I don't like Scotiabank. Never liked it for like decades. So of course, Scotiabank is my number six. But I'm gonna stop there because I want to listen to yours, and then we can get the ball rolling.
Well, we agree on number six. Number six for me is Scotiabank as well. Now, I'll qualify this a little bit and say that number six for a Canadian bank is not such a bad company. And this is where Mike and I are going to disagree a little bit because I own Scotiabank and I have owned it for a while. It has been a disappointing part of my portfolio, but I think that there are some good things there. And I'll highlight sort of this turnaround plan that's happening under the new CEO, Scott Thompson, which is, of course, Scotiabank is the most international of Canadian banks. I believe about a third of earnings come from international operations. And these are mostly located in Latin America. The big areas are Mexico, Chile, Peru, Colombia, and the Caribbean. There's a few other ones scattered in there, but that's the point. And these assets that Scotiabank owns, some of them are good and some of them are not so good. You look at something like Colombia, and Scotiabank has struggled in Colombia for a long time. Panama, Costa Rica, these are areas that they just can't get any traction. So they're in the process of selling these assets, which I think is a massive benefit over the long term because when you give investors a bad part of your company to focus on, all they're gonna do is focus on that. They're not gonna focus on the good stuff. And I think that some of Scotiabank's assets, you look at Mexico, their Mexican assets are excellent. They generally return about 20% return on equity, which is very good for a bank. The assets in Chile are pretty good. The assets in the Caribbean are also very good, 30% plus returns on equity. So there's some good stuff there. They just have to get rid of the crap. And once they do, I think that the market is going to say, hey, this is better than what we gave it credit for. And there's some upside potential there.
I will have to agree on one point with you on this is even though it's ranked sixth, it's probably better than at least half of the stocks traded on the TSX. So it's I mean, we're talking about Canadian banks. You cannot really go wrong for a bank. As you mentioned, what I don't like about Scotiabank is really the fact that their international exposure has been a very seductive narrative for the past 15 years but never move the needle constantly. So sometimes they have great quarters, sometimes it's bad. The recent one, Q3 25, that they just reported earlier this week, international market actually did better than the Canadian market. So Canadian net income was down 2% on higher PCLs, and international market was like up 6-7% with lower PCLs, which is kind of interesting. So that part is yeah, they're doing this turnaround. I'll just sit there, wait and see. But definitely, if you're in for the yield and you want a kind of like a bond proxy, which I called a deluxe bond, Scotiabank could make it. So that's fine. Number five. Number five, I must admit, it's still there in my ranking, but they will likely move up if they continue to perform this way, and it's CIBC. The problem I had with CIBC for many years is they never seem to have a clear strategy. I mean, I have to give it to Scotiabank. They had a clear strategy. They're just like, yeah, you know what? We're going international. BMO is all about investment, wealth, capital markets. TD is all about the US, and our Royal Bank and National Bank are more diversified, like a 50-50 type of business. But CIBC, they were a little bit everywhere, a little bit in the US, a little bit in wealth, a little bit in capital markets, but never seems to crush it. Even actually in 23, I think their provision for credit losses started to increase like there's no tomorrow. And now it's been 18 months. They are performing like crazy. Like probably I haven't looked at it, but probably if you look at the total return for the past 18 months, probably the bank that has made the strongest comeback. So which one do you have on number five, Nelson?
So we disagree a little bit here, but not much. I would put BMO as number five, and your points about CIBC are actually they're good points. That there isn't that strategy and whatever. But I think that with CIBC, investors have sort of fell back in love a little bit with this Canadian story. You know, CIBC has sort of the least amount of U.S. foreign exposure in the Big Five. Anyway, of course, National Bank's very Canadian centric, but I think that that's sort of the story with CIBC. But in terms of BMO, they made that big acquisition in the U.S., Bank of the West, and that I believe closed in late 2023, early 2024, somewhere in there. And they
Pretty
just
bad
haven't
timing,
been able
actually.
to. Yeah, and not only that, but like they just the results from there, you know, the American banking sector has really recovered nicely. You look at the big American banks, the JP Morgans and those guys, their stocks have done unbelievably well in the last year. And then you have BMO and Bank of the West, and Bank of the West results just aren't there. And it's pulling down the entire US part of BMO. And that's become a very big part of this company compared to before. You know, it's like 35-40% US earnings is my recollection. So you just have a bank that just isn't really executing on the US side. Now their recent results were a lot better and it looks like they may be turning a corner there, and I think that's part of the reason why you saw the big rally in BMO shares earlier this week besides the good results. So it looks like they're turning the corner there. It's just I need to see a couple more quarters of good results from the US to just demonstrate that there's good assets there and that BMO's doing a good job of turning them around before I can put them higher on my list.
Yeah, and it's one thing I don't like about banks in general. We just saw this with CIBC a year ago, where they tend to be very conservative. So they crank up their provision for credit losses. So that's money that they set aside, thinking we're going to lose money on some loans. But they tend to be super conservative on that. So whenever you increase your provision for credit losses, also known as PCLs, you heard the earnings. So of course it goes like an expense. So the earnings per share will drop accordingly. So what happened with CIBC? Now they made a big comeback. Well, with the recent result for BMO, this is exactly what happened. So when you look at earnings per share up 22% for the quarter, the revenue were only up by 10. So the difference has been found in better, like lower PCLs on the US side. So on the Canadian side, it's actually increasing, but on the US side, it was like the earnings per share were up 42%, mostly driven, almost entirely driven just by those PCLs recovery. So basically, after a year, you're just like, oh, I'm not losing money on those loans, so I will have to recover that PCLs, crank up the earnings. So it's kind of shaky sometimes, but I have it a little bit higher. Actually, I used to have BMO on my fourth spots, but for my fourth spot, but now I have TD. And the TD story, I always find it fascinating. So that's my number four right now. I love the fact that they executed very well in the US, better than most banks, and it has been a struggle for Canadian banks too. They always eye the US market, but most of the time they fail at being successful there and growing. And TD had an amazing success until the money laundering problem that they had about a year and a half, a year ago in 2024. They got the fine, they got the capital asset cap there, but suddenly the market just starts loving TD. Not too sure why. I mean, the results are not that bad actually. They're selling some assets, they're doing some recycling, which is smart. So they improved their balance sheet. That's all good. But I just asked myself why the stock is going high so fast. Again, not a bad bank. I mean, definitely a great company, but I'm just surprised by the comeback without having incredibly strong numbers. I don't know which one you have on number four, Nelson, but yeah, this one I'm just a bit puzzled by the returns that we see at TD at this point. Not that I thought it would go down forever, but I kind of saw it like, oh, it's going to be in the penalty box for like a couple of years, maybe 2 3 years. Most likely going to look like a bond proxy for 2 3 years, like another Scotia Bank, and then it's going to come back. But now it's already coming back like a few months after all this happened. So I don't know. Like, which one do you have on number four?
Well, I had would put CIBC as number four, but I would put TD as number three. So it's a good time for us to talk about it. I definitely agree with your assessment, and I remember, back in the summer of last year when this was all kind of first coming out. Um, Wells Fargo was the example that everybody used. It was Wells Fargo had this happen to them, and for 6 or 7 years, the stock was just flat. And everyone looked at that and they assumed that TD was going to do the same thing. I wasn't quite as pessimistic, but I was definitely a little bit pessimistic because
Yeah.
this is a big deal to get this giant fine slapped on you because you're essentially helping drug organizations launder money. Like, this is exactly what you don't want to do as a bank. So,
And you're doing
big
this
deal.
in another country. So, I mean, the US had like no problem whatsoever to slap a Canadian bank. Actually, I'm pretty sure they were happy to do it.
Yeah, that's it. Like, and the punishment, you could argue they got off light. Like, you could argue that the U.S. government might have said, just get out of our country and don't come back. Like sell the assets, go away, which is obviously not a good solution. So I think that TD has done a nice job communicating back to the market where they said, okay, we know that these US operations are just sort of stranded there for a little while. We're just going to ignore those for a little while. And here's what we're going to do. We're going to buy back stock. We're going to focus on Canada. We're going to do all these other things. And of course, kicking out the old CEO is a massive win for them too as well. You just kind
Yeah.
of get to reset the company and go from there. I think too, there's this expectation that the new guy Raymond Chung, he's going to come in. He's going to have this big strategic vision, and he's just going to sort of lead the company back into this promised land. He hasn't really, like, the plans are just vague at this point, but I think that the expectation of this big plan is really what's driving the stock higher. And there may be some disappointment in the future if this plan comes and it's just buy back more stock and invest in the Canadian operations. It's just boring, but it's probably what they should do.
Yeah, it's definitely driven by the narrative more than by the numbers at this point. But I mean, again, I mean, they recovered faster. Now after that, maybe we're gonna have like a kind of like a plateau or a pause in terms of stock price growth, and it's still going to be a very strong bank. So we'll see how it goes. On my side, it went from number three to fall to number four. But again, those were really in the middle of like those small details. Not going to scream at you because you don't agree necessarily for one position or another. Because seriously, they like depending on the quarter, we could like put them one in front of the other and vice versa. So it's all good. What I found very interesting is now we're getting to the top two, and I'm very curious which is your top one on this time. Most of the time, they don't change. And on my side, those are the two banks that I own. So I will talk a little bit about the number two and number one, and then we'll see if you have the same order. So as number two, and honestly, I could shift them in my ranking, but I don't know. I work at National Bank for too many years, so it has to stay at number one for a while. So Royal Bank is my number two. Uh, there are a lot of things that I love about those two banks that they have in common. The first one is the diversification. Those two banks have roughly 50% of their operations that are coming from personal and commercial banking. So the classic activities that all banks have. But then they have the other 50% of their revenue coming from capital markets, insurance, wealth management, going international for National Bank over the past few years. Now they bought ABA Bank and they have Credit G in the US. And that created something interesting because a lot of people will say, oh, National Bank is centered in Canada and even more in Quebec, and that's fair enough. Now they are on a path to expansion with the acquisition of Canadian Western Bank. Over their latest quarter that was reported yesterday, they already announced more synergies being done there. The personal and commercial banking revenue were up, mostly driven by the acquisition as well. The problem I see, though, I see two problems with National Bank, even though it's my favorite one because it has the strongest dividend growth over the past 5 and 10 years, the lowest payout ratio. The like what I like to analyze is the dividend triangle. So the revenue growth, the earnings per share growth, and the dividend growth. They're all beating like all the other banks. But the problem I see right now, and I'm a bit concerned about that, is the provision for credit losses are increasing so much that when you look at the net income, the personal and commercial banking, so their classic activities, are now almost as important as capital markets. And capital markets are great, don't get me wrong, but they're incredibly volatile. So on one quarter, you could be up 25%. The other quarter, you could be down 25%. And that would be totally normal because, I mean, you're dealing with investment banking, you're dealing with the stock market. So sometimes you have good deals, sometimes you have bad deals. And actually, BMO has been known for for having those hit and miss for this segment. But I will still keep Royal Bank as number two. It's kind of like the sleep well at night, never worry about those results. And again, yesterday, double digit revenue growth, double digit earnings per share, and double digit across all market, all segments, besides commercial banking that was up 2% on IRPCLs, but that was pretty much it. So I'm going to stand there and I'm going to let you tell me, Nelson, which is your favorite bank.
I think that both Royal Bank and National Bank are excellent, and they're both worthy of anybody's top two. Whether one or the other is two or one, I don't think it really matters because they're both excellent. Now, saying that, I put Royal Bank a little bit ahead of National Bank. And the reason is Mike, as you alluded to, National Bank, I think, has the better growth potential inside of Canada. They've focused on Quebec for a long time. That's been a good strategy. But, and so they don't have as many assets inside of Canada. You talked about the acquisition of Canadian National Bank. That's great. I live in Western Canada. There's basically no National Bank exposure out here, so that's good.
Yeah.
But ultimately, for me, Royal Bank is it's like the 800-pound bully that everyone has to go up against in the banking world, and it's really hard to compete with Royal Bank. They're the management's great. They have a dominant position in virtually every Canadian kind of personal banking category, whether it's deposits, whether it's GICs, whether it's mortgages, all these things. Royal Bank just dominates. They're either number one or number two. And when you're in that position, everyone has to try to dethrone you. And that is extremely hard when you go up against Royal Bank.
Yep.
And then their expansion to the US, they've really focused on quality assets, I thought. And these are just solid US assets that they've been able to execute with that BMO and some of their peers have not been able to execute with. So you kind of put those things together. And for me, Royal Bank is just the king. Royal Bank, the king, obviously. And
Yeah.
they're just like, it's just such a solid company with these guys like they're worried about the downside always, and they don't want customers who are kind of risky. There's just quality is in every part of what this bank does. National Bank too as well. They have a lot of the same qualities, but ultimately for me, Royal Bank is number one. Fantastic company, my largest bank position, and I don't see that changing anytime soon.
What strikes me as well compared to other banks for Royal is they don't seem to make mistake. Like, like TD got caught with money laundering. BMO is like on and off on quarters and the acquisition of Bank of the West. CIBC was going nowhere for a while. It was kind of hard. Scotiabank made some mistakes in their international exposure. Even National Bank from time to time get caught with they got caught with commercial paper back in 2008 in the financial crisis. That was the
Mhm.
only bank with a sizable, I think it was like 1 or 2 billion of commercial paper. In their balance sheet. So, but Royal Bank seems to always, like as you said, like focus on quality, not taking too much risk, but doing it very nicely. So depending on if you want to go for quality or for growth potential, those should be probably number one, number two. Again, not financial advice here. We're just two dividend enthusiasts sharing our views about banks. And I want to thank you, Nelson. That has been like a lot of fun. I want to keep those short, so I'm gonna wrap this up. So my top six: Scotiabank, CIBC, TD, BMO, Royal, and National. Yours, just as a summary?
Mine are Scotia, BMO, CIBC, TD, National, Royal.
There you go. Awesome. So, all right. If you have enjoyed this episode, do not forget to go on the podcast, give us a 5-star rating. In the show note, you have the link to also register to Nelson's newsletter. It's amazing. He's doing those reviews of Canadian dividend paying stocks. So I suggest that you register. It's going to be in the show notes. It's going to be on the YouTube channel as well. And until tomorrow morning, do not forget to stay invested.